Hello, welcome to Allgen's Market Update. Today is June 10th, 2019. My name is Jason Martin. Today I want to cover a few big topics. Before we get started, in case you hear some background noise, there is a lot of construction going on. If you've been to our offices recently, it's something we unfortunately have to deal with. Maybe it's a sign of progress, but either way, it's annoying. So if you hear that in the background, we're aware of it, and trust me, sometimes we want to go home because it's so loud. But let's get started. So looking at the market right now, a couple main points I want to bring up. Number one, last time we talked in May, we had talked about the S&P 500 hitting a key resistance point. It did, and it actually went down, but then it bounced. So let's take a look at where we're at right now. So right now, this is the S&P 500, and as you can see right here, you had the October drop, the fourth quarter drop of last year, the rally back up. This was the key resistance point I was talking about, and then the market did drop and have one of the worst Mays in a long time. In fact, the S&P 500 and a lot of other markets were down over 6%. Well, that brought us down to the 200-day moving average, which is this blue line down here, and it bounced off that, and quite a strong bounce. So right now we're heading back up, possibly to retest this resistance. We'll see where we go from that point. But a couple of things that causes me concern, and something that we've mentioned for a while, that it has ramifications for a potential recession, which is the yield curve. And the yield curve, in particular, the yield curve going negative, or what's called an inverted yield curve, is going further. It's inverting further right now. So let's take a look at what that looks like. So basically, what the yield curve is, and I've mentioned this in the past, but just a quick review. Typically, you have interest rates on the lower end, meaning shorter term interest rates at a lower yield, and longer term interest rates at a higher yield. Okay, that would be a normal what's called yield curve, and so that would essentially say we're in a normal scenario. So in a strong economy, you have long-term interest rates much higher than shorter-term interest rates. That's a steep yield curve. That would indicate a strong economy. The opposite of that is when yields start to flatten, which is where basically you have short-term interest rates equal to long-term interest rates. And that started to happen around October of last year, which caused us some concern, and that's a red flag. Well, the worst case scenario is when yields invert. And so that's when short-term yields become higher than long-term yields. This particular chart is looking at the 3-month Treasury note versus the 10-year Treasury bond. And so right now it's saying that the 3-month note actually has a higher yield than the 10-year Treasury bond. And so if you can see on this line right here, this is the 10-year Treasury minus the 3-month, and this horizontal line right here is the 0. So once you go below 0, it's considered inverted. All right, and you can see we hit that. We mentioned it first in March when we went inverted for a very short time frame, and then it bounced back up, and now it's gone even further negative. So if you're looking at this chart, and this goes back to 2000, actually 1999, these gray areas are recessions. The last two times in this chart that the yield curve went inverted, it actually led to a recession, okay? And it gave us a signal of a recession on average about 11 months prior to the recession happening. So, and even if you go back further to 1968, it's predicted 7 of the last 7 recessions. And so that has caused us some concern, and there is a good chance that in the future, maybe 10, 11 months from now, that we could possibly be heading into recession. But we have to be ready for that, because the stock market leads the economy, which means the stock market, if we were going into recession, would typically start to go down prior to us going into recession. Of course, there is no perfect indicator, but this is one that has been very accurate over the long term, so we want to be ready just in case. And if we're wrong, we'd rather miss out on the upside of the market, but if we're right, our preference is to protect our clients. So let's take a look. What else? Here we have federal funds futures rate predicting lower interest rates. This is another thing that we've been pointing out, but now it's become a much stronger signal of lower interest rates to come. So if we look here, this is what's called the federal funds futures rates, which gives probabilities of future interest rate yields. Okay, right now we're looking at the January 2020, and so right now we're between 2.25% to 2.5%. That's where the federal funds futures rate is now. Well, going into last year, the Federal Reserve raised interest rates 4 times, and at the end of the year, which caused the market a lot of it caused the market to decline even further, when the Federal Reserve came out and said that they were going to raise rates 2 more times in 2019. Well, the Federal Reserve made the announcement in January that they're going to hold rates steady, and then just recently, for the first time, I think it was last week, the Federal Reserve came out and said they're open to potentially lowering interest rates and to combat, if you will, the trade tensions that the United States and China, and even for a short time period Mexico is having. So right now, the probabilities of an interest rate decrease or a rate decrease is at about 99% chance that we will decrease rates by January of 2020. And the highest likelihood and the greatest probability is that we'll actually be, we'll lower rates 3 times or 75 basis points. So what does that mean? Number one, that means the Federal Reserve is concerned about the economy. Number two, it's important to know that when interest rates go down, bonds typically go up. Bond prices go up. Okay, so this is something that we've been doing with our portfolios to prepare for a potential market decline. We've lowered stock percentages. Okay, we reduced our stocks. At the same time, we've increased our bonds, and in particular, we've increased long-term government bonds. Those have gone up quite a bit as the thought or the perception of interest rates is starting to look like they're going to decline even further. And so, part of the reasoning for us to lower stocks is to be defensive, but the other part is to take advantage of bonds that are going up. So that's where we're at right now for what we're seeing in June. And I appreciate everyone watching, and we look forward to having more of these updates and keeping you guys informed. And we'll talk to you soon. Take care.